Your 1 lakh rupees investment will drop straight to just 45,000. Here, by putting a margin of just 900 rupees. If gold goes up by just 1%, you can make a profit of 1200 rupees. The factors that historically increased gold prices are currently warning of a massive financial crash. A 20 to 25% correction is possible, which could bring current prices down to the 90,000 level. The super rich frequently park their black money in here, which is precisely why the demand for gold just keeps on rising. And now middle class people can't even afford to buy jewelry for important weddings at home because gold prices are constantly increasing. That's basically a 66% profit, and that too in just 10 days. Look at this absolutely terrifying prediction on the screen. Do you know that Morningstar's US-based analyst John Mills has actually predicted that the gold prices could basically crash by 40 to 50% from here, and they could fall to as low as 56,000 rupees per 10 grams. From the current rate of 1,24,000 straight down to 56,000, that is clearly less than half of its value. If you really think about it, your 1 lakh rupees investment will drop straight to 45,000 rupees. And this prediction has additionally been featured in Economic Times, Business Connect magazine, and multiple financial publications. So this is not just a random guess. But wait, at the same time, an analysis from Bajaj Finance has a completely opposite prediction. According to them, the gold prices are actually expected to rise to 2,69,798 rupees by year 2025 and 3,25,470 rupees by 2026. That implies that from the current rate of 1,24,000, it is effectively more than double. The confusion is at an extreme level because one expert says the price will drop to 56,000 while another predicts 2,70,000. Look, this isn't just a game of numbers. This is going to decide your financial future. If you make a wrong investment decision and the Morningstar analyst turns out to be right, your 2 lakh rupee investment will become significantly less than 1 lakh. But if Bajaj Finance was actually right and you miss this big opportunity, 1 lakh could have become 2.5 lakhs, but you would sadly miss out. Today, I am also going to introduce a system where, by utilizing a margin of just 900 rupees, you can make a profit of 1200 rupees if gold goes up by just 1%. That means a profit even greater than your total investment. And what is more, you can even profit when the price of gold falls. Watch the video till the end as I'm going to explain both systems in detail. Apart from this, today I will give you, with exact science and mathematical calculations, a real answer and insight in order to figure out as to what the next target and price for gold could actually be. It does not matter what people claim. We must take this information very seriously indeed. Because today, gold is becoming a major part of everyone's portfolio. But first, look at this shocking historical fact. Gold has witnessed a truly remarkable and incredible journey throughout India from 1950 to 2025. A remarkable journey from 100 rupees to over 1 lakh. This is a massive 1000x growth over the last 75 years. Imagine if your grandfather had invested just 1 lakh rupees in gold all the way back in 1950. That value would exceed 10 crore rupees. And if he had invested just 10,000 rupees, its value today would be 1 crore rupees. This isn't some fairy tale, it is documented history. And a fact. According to Motilal Oswal's analysis, the price of gold in 1950 was just 99 rupees per 10 grams. And at the start of 2025, it had crossed even 80,000. So this means the price of gold has almost doubled every 8 years. And in the last 3 years alone, if you look at it, gold has delivered even more explosive returns. In 2019, 24-karat gold was trading at around 36,000, which reached around 80,000 in 2024. And in 2025, it crossed 1,25,000. In the current scenario, prices are already up by 52% in just 1 year. Right now, as I'm making this video, the price of 10 grams of gold is roughly 1,25,000 rupees. So the question is whether this momentum will continue or if a correction is on its way. Consider that Morningstar analyst John Mills recently predicted that the price of gold would crash to 56,000. And there is actually a specific scientific reason behind it. The main reason is that real interest rates remain negative for non-yielding assets like gold. When government bonds start offering much higher returns, the demand for gold naturally begins to decline because people start shifting their money into bonds. Their professional analysis suggests that gold mining output has increased quite significantly. For example, mining profits in Q2 2024 had reached $950 per ounce. And in addition, global gold reserves have increased by 9% to 216,265 tons. Plus, recycled gold supply has increased, which is disrupting the supply and demand equation. David Sekera, Morningstar's chief US market strategist, says that the factors that historically drove up gold prices are now warning observers of a truly massive market crash. The extremely aggressive buying from central banks, which was over 1,000 tons since 2022, might possibly slow down now. In a recent survey, 71% of central banks have communicated their intention to decrease their gold reserves or keep them unchanged because the price is already very high. Plus, due to the strength of the US dollar and the Fed's hawkish stance. And as real interest rates continue rising, this remains a quite bearish signal for gold. But on the other hand side, Bank of America instead projects that the price of gold could in fact rise instead of reducing. This bull case is primarily based on ongoing geopolitical tensions, inflation concerns, currency debasement, and the need for central bank diversification. The RBI is also consistently buying gold. In the year 2025 alone, 57 tons have already been added to the total reserves, which have now reached 880 tons. This is a calculated strategic move intended to reduce the overall dependency on the dollar and to maintain economic sovereignty. And besides, the value of gold in India is completely different compared to other countries. Unique factors are at play in the domestic market. In India, gold is a cultural necessity. Gold is considered mandatory at weddings, festivals, and religious occasions, regardless of the price. This strong base demand always exists, which effectively provides a stable price floor. Looking at current data, despite high prices, demand during wedding season and festivals will remain consistent. The import duty structure, 15% plus 3% GST, also provides a price cushion against major crashes. The weakness of the rupee is another supporting factor. The current USD to INR rate is around 85. If it weakens to 88 or 90, then the price of gold will automatically increase by another 8 to 10%, even if international prices remain stable. Historically, the rupee has consistently remained quite weak against the dollar in the long term, largely because of the trade deficit and persistent inflation differential. Let's make a realistic calculation based on multiple scenarios. In a conservative approach, considering the 20-year average CAGR of 13.8%, then starting from the current price of 1,24,000, the estimated prices for the next 3 years would be as follows: 1,42,000 in 2026 and 1,64,000 in 2027. And 1,90,000 in 2028. These targets are quite consistent with historical trends and also seem practically achievable. In an aggressive scenario, if geopolitical tensions escalate or a major currency crisis occurs, or if inflation continues to spiral out of control, then an annual growth of 20 to 25% is possible. This could potentially take prices into the range of 2 lakh to 2,40,000 by 2027. In a bear case, Morningstar could be partially correct. A 20 to 25% correction is possible, which could bring prices down to the 90,000 level. But a fall to 56,000 is extremely unlikely, because production costs, import structures, and cultural demand provide strong support. Think about it. Considering gold is currently 124,000 rupees, still, people are paying up to 1,40,000 for it after paying 10 to 12% in making charges and a 3% GST. The most interesting thing in India is that there are so many scams that a lot of people don't even realize. Jewelers often sell 22 karat gold to customers at the price of 24 karat gold and give a 2 to 3% discount. And the customers reacting to it seem to think that, wow, the jeweler is so nice. See, the purity of 24 karat gold is 99.99%, whereas the purity of 22 karat gold is only 91.6%. So technically, if the price of 24 karat gold is 1 lakh, then the price of 22 karat gold would be 91,600. That's why 22 karat gold jewelry has a 916 hallmark. And when it comes to 18 karat gold, its purity is just 75%. This means that 10 grams of 18 karat gold will cost only 75,000 rupees total, and that is exactly why it has a 750 hallmark. But in reality, this is one of the ordinary and basic scams only. The real problem actually starts when you go to sell your old gold. Jewelers will typically deduct 10 to 20% of the total amount, which is completely illogical. Because according to established scientific data, the total gold melting loss is merely 0.5 to 1%. According to Bajaj Finance's research, the actual loss in professional gold melting is very minimal, from around 0.5 to just 1%, due to trace impurities, evaporation, or mistakes in handling. But even then, jewelers deduct 10 to 20%. This means the customer is being robbed. According to the World Gold Council's data, gold recovery is greatly maximized when using professional and organized refining techniques for the metal. Reliable companies like Kundan Refinery guarantee that we will return 100% of your gold back without any refining loss for proper gold content. But fraud is very common among local jewelers and in the unorganized sector. The technical reality is that the actual loss in gold melting is less than 1% if done professionally. But unfortunately, many customers are told there is a 10 to 20% loss. Additionally, cases involving fake hallmarks have now become a very serious and widespread problem in India. The BIS recently caught jewelry shops in a raid filled with counterfeit hallmarks. In the classic Carat Assay Lab case in Andheri East, the operators were utilizing spurious hallmarks without possessing valid BIS recognition or approval. Look at this article from Business Standard. US woman sold rupees 300 jewelry for rupees 6 crore, thinking it was genuine gold, but it all turned out to be fake. In Kasaragod, a cooperative bank was defrauded of 18 lakh with fake gold bangles, where only 25 to 35% was real gold, but it had a proper purity mark. By the way, there is another key reason for the rise in gold prices, which is never openly discussed by the media. That is simply black money. Such black money is parked in gold. Based on the reports from the Central Board of Direct Taxes, individuals holding black money typically invest 91% of their wealth in various non-cash assets, including Benami properties, bullion, and jewelry. Government reports clearly mention that due to this black money, productive resources frequently get diverted into gold and precious jewelry holdings. Thus, the overall saving and investment pattern gets distorted. The comprehensive household survey by the India Gold Policy Center reveals that it is very simple to convert gold into ready cash, and it can also be leveraged for instant loans. That is the fundamental reason why unaccounted wealth is frequently parked here, and this represents a truly attractive option for many people. Even today, people continue to use gold for black money. Even if you look at the analysis that was done by World Gold Council, they admit in their analysis that the cash purchases account for a meaningful share of gold transactions. And when it comes to RBI's Household Finance Committee, there they have specifically mentioned that for wealthy individuals, gold is a preferred asset for tax evasion purposes. If you don't believe it, then look at the evidence. For example, a recent income tax raid in month of December 2024, a raid on the premises of Congress MP Dheeraj Sahu, yielded 351 crore rupees in cash, as well as nearly 3 kilograms of gold jewelry, which represents the single most significant cash seize ever recorded during any action taken by a federal agency in India. Do you fully understand what 3 kilos of gold means? It is gold worth almost more than 3 crore, and its value is increasing every day. In that very same month, 23 distinct locations belonging to the transport businessman Tikam Singh Rao were raided across Rajasthan. In that particular raid, an astonishing 137 crore of unaccounted wealth was seized, including a substantial 45 kilograms of undeclared gold that was worth 38 crore rupees. And indeed, this is the largest gold recovery ever in Rajasthan. Can you believe that individuals are holding 38 crore worth of gold as black money, and furthermore, just in May 2024 within Maharashtra's Nanded location, a major raid conducted on the Adinath Urban Cooperative Bank led to the seizure of unaccounted property worth 170 crore rupees, which included staggering 8 kilograms of gold, and to top it off, another 14 crore rupees in cash. Income tax officials have the authority to confiscate any and all unaccounted money, jewelry, and gold. Under Section 132, officials act specifically to track black money. All these investigative raids clearly show that for massive tax evasion, gold is a truly preferred asset, which is why its demand remains high. Rich people park their unaccounted money in this asset, which is why the overall demand for gold just keeps on rising. And middle class people can't even afford to buy the required jewelry for weddings at home, as gold prices constantly climb. But don't worry, today I am going to tell you about two very useful systems through which you can trade in gold and also accumulate even more gold in the long term, that too starting with just 800 to 900 rupees. First, let's talk about trading. See, just like we trade shares on the NSE and BSE, similarly, gold and silver are traded on the MCX. Gold futures and gold options are two ways that allow you to profit from the short-term movements we often see in the market. Gold futures are traded on the MCX, which is the multi-commodity exchange. Furthermore, you can also trade in both gold and silver through Dhan. On MCX, the standard lot size for gold futures is 100 grams. And to trade in that, a margin of about 7 to 8 lakh rupees is usually required. But I understand that having such a large amount can be a bit difficult. But in such cases, you can trade in gold mini futures. Here, a margin of only 80 to 90,000 rupees is required. And if you have even less money, then you have the alternative to trade in gold petal futures. For this particular option, you can easily take trades in gold petal futures with just 900 rupees. This is truly the world's first 1 gram gold contract that is currently traded on the MCX exchange. You see, the gold petal contract was specifically designed with both retail investors and the middle class in mind, enabling us to trade and invest gold. The managing director of MCX explicitly stated at the launch that this product will democratize gold investment. Why? Because here, investment can start from as low as 800 to 1000 rupees. Look at the contract specifications. The lot size is only 1 gram with a purity of 999. The margin required is 800 to 900 rupees, costing under 1000 to trade, approximately 7 to 8% of the contract value. Trading hours are officially from 9 in the morning until 11:30 at night. This really means you can comfortably trade even after finishing your daily work. With gold at 1,24,000 per 10 grams, a single gram is worth 12,400 rupees. But in futures, you don't need to invest the full 12,400 rupees. Margin requirements are 7 to 8%. With margin on 900, you can take position of 12,400, and this really demonstrates the power of leverage. When the price moves in your favor, the potential profit also gets multiplied accordingly. But if the market price goes against you, the total loss can also be multiplied. Let us try to understand how this works with examples. Suppose the current price of the October 2025 gold futures contract is 1,24,000 rupees per 10 grams. You think the price of gold will increase. Why? Because you have done your analysis. You've read the news, central banks are buying, and geopolitical tensions are rising. The Fed is about to cut rates. Therefore, you decide to take a long position of 1 gram in gold petal futures where the necessary margin requirement is only 900 rupees. Now, if you assume that the price increases to 1,30,000 rupees in the next 10 days, you will make a profit of 600 rupees. The price of 1 gram of gold is now 13,000, up from 12,400. So you will make a profit of 600 rupees. This means your total investment was 900 rupees, but the return on investment was 600 rupees. That represents a 66% return on investment in 10 days. However, mind the risk. If the price drops to 1,20,000 rupees, you could face a loss of 400 rupees instead of profit. So, futures trading is a high risk, high reward game. You can become a millionaire overnight, and you can also lose everything overnight. Whenever you trade futures and options, use careful consideration. Gold options trading is even more interesting. You get even more leverage in options. Let's look at a recent example that actually happened. In May 2025, there was a very big move at the end of April. If you remember, on April 22, there was a terrorist attack in Palgram in which 26 tourists lost their lives. After this, tensions between India and Pakistan escalated sharply and military conflicts began on May 7. During this period, the gold price on MCX was trading at roughly 93 to 95,000 rupees. Call option of 1 lakh rupees for the June expiry was available with a premium of around 1200 rupees. With a lot size of 10 units, your total investment was 12,000 rupees. Now, you think that before expiry, the gold price will go above 1 lakh. So you bought this call option. By late May, only 3 to 4 weeks later, the gold price had surged to over 1,04,000 rupees due to geopolitical tensions and the India-Pakistan conflict. Now, your 1 lakh rupee call option, which you had bought for 1200 rupees, saw its market price reach almost 5,500 rupees because the gold price had already officially crossed 1 lakh. And you held the legal right to purchase at 1 lakh. This means there existed intrinsic value, time value, and significant volatility. Essentially, you invested 12,000 rupees and the total value increased to 55,000 rupees. That's a profit of 43,000 rupees. The return generated was almost 358%, all in just 3 to 4 weeks. This is an example from 2025 when gold prices shot up due to India-Pakistan tensions. But this is only one side of the story. If the gold price had not gone above 1 lakh but had remained at a lower level or moved sideways, then your entire 12,000 rupees would have become zero. Options trading involves time decay. So with each passing day, the actual value of the option decreases if the price does not move in the expected direction. So eventually, on the day of expiry, the option's value hits zero and all capital is lost. For options trading, you must remember these rules. To begin with, you should have a very good understanding of trading and the market. Number 2, you should know technical analysis. Number 3, you must certainly know risk management. And number 4, the most important, you must be willing to accept that you can also take 100% loss. That is, lose all your investment. But if you really want to trade in the gold futures or options, my suggestion would be to first start with paper trading instead. There are many platforms that provide paper trading facilities. Trade with virtual money, test your strategies, and understand the market's movements. Only then should you invest real money. Otherwise, you may suffer a loss. And when you do invest real money, start with small positions. Invest a maximum of 5% of your total available capital in any single trade. And never, ever try to trade without a stop loss. In trading, risk management is the most important skill. And you will have to learn to control greed and fear. When you are making a profit, don't get greedy and over leverage. When suffering a loss, don't get scared and start revenge trading. Stay disciplined, stay planned, only then will you be able to make a profit in the long term and become successful. If trading in gold seems risky to you, please do not worry because you can comfortably build wealth in the long term. And for this, I want to describe another effective system. The systematic gold accumulation strategy. In this particular approach, you basically invest 5,000 rupees monthly by dividing it among a lot of different forms of gold. 2,000 rupees in gold ETFs. Here you can also invest in HDFC Gold ETF or SBI Gold ETF and 1,000 rupees in silver ETFs. Because the demand for silver is also increasing very rapidly. That is because after such a big rally in gold, analysts are equally bullish on silver. For ETFs, Dhan's ETF tracker is definitely the best. You can simply go to Dhan's ETF tracker. Click on Gold ETF and a list of all gold ETFs listed in India will appear on your screen. Here, on a single screen, you will find the names of all gold ETFs. last traded price, NAV, and assets under management in crores. Volume, 52-week high, 52-week low, 1-month return, 3-month return, 1-year return, 3-year return, 5-year return. Expense ratio, you will get everything. Dhan's ETF tracker is truly an amazing game changer. Whichever ETF you want to buy, just type it here, compare, and make your decision. You can sort the entire list of all of the available ETFs in any way you want. If you want the cheapest ETF, click here on NAV. The entire list will be arranged from low to high NAV. You will get both low to high and high to low lists. If you are looking to identify which ETF features the lowest expense ratio, just click on the expense ratio. This means on Dhan's ETF tracker. You get full data for every ETF category with one single click. Not only that, if you want details of a specific ETF, click on it and you'll get all the data there as well. And if you truly want to, you can also multiply your total investment returns by up to 4 times. This means while others who invested in this ETF earned a 52% return in the last year, you can make a 200% return. This is primarily because Dhan actually provides you with the MTF, which is the margin trading facility for investing in ETFs. This feature allows you to use leverage of up to 4 times your available capital for your trades. To explain in simple words, if you have only 10,000 rupees in your account, you can still easily purchase ETFs worth up to 40,000 rupees by utilizing the MTF. Now, if that ETF actually gives a 50% return, you will make a profit of 20,000, which is 200% of your actual investment of rupees 10,000. But the risk is also high in margin trading. When the price of the ETF falls, you also incur a larger loss. Use MTF based on your risk appetite. You might ask, why physical gold? Look, sooner or later, there is always some family function at our homes. And in most cases, we always prefer to gift gold. That's when these coins and bars come in handy. Buying jewelry is often a waste, because the specific design or pattern you really like right now might become quite outdated or completely go out of fashion much later on. It is actually much better to buy gold coins and bars instead, simply because they have no extra making charges. And in the future, whenever you want to get jewelry made, you can use them. You only pay the making charges, nothing more. So, in this way, physical gold can also help you in the long term. But I'm not actually saying that you should never buy any jewelry. If you need it to wear for some occasion, then of course you have to buy it. But if you must, then you should instead opt for more long-lasting and evergreen designs. But definitely not for pure investment. In an advanced strategy, you can also use gold loan arbitrage, through which, along with gold price appreciation, you can also earn an additional 5 to 10% return every year. This system is a bit complex. This particular system is only useful for those with a high risk appetite. I will be making a separate video on this very soon. Subscribe to the channel so you don't miss this video. And yes, there is also a strategy through which you can on the gold that is lying in your house. Earn some extra returns every single year, just like a standard bank fixed deposit. All you have to do is simply deposit the physical gold into the bank, and then the bank will pay you a fixed interest rate every year. Ultimately, it will also safely return your gold to you. This means you will also benefit from the increase in the price of gold, and you will also get a fixed interest every year. I am going to cover this in that video as well. So, subscribe to the channel right now, or you will miss that video. If you really liked the video and found it useful, please give it a like. I have put links to some more insightful videos in the description. Do check them out. Jai Hind.